All right. All right. Welcome. Thank you for joining our webinar, The Primaries of Secondaries, a market update on secondary transactions in a post-COVID environment. All participants are in listen-only mode. You're encouraged to submit questions throughout the program through the Q&A section, which is located on the right side of your WebEx window. We'll do our best to get to everyone's questions at the end of the program, and copies of the webinar recording and presentation materials will be made available in the days to come. I'm very pleased to be joined today by Mike Custer and Jake Seyfarth from M2O Private Fund Advisors. Mike is a partner and the head of secondaries at M2O and has been advising clients on secondary transactions for more than 15 years. Prior to joining M2O in 2018, Mike spent 13 years at Credit Suisse, where he was global head of secondary advisory, as well as a senior member of the origination committee, a senior project manager in the fundraising business, and a senior member of the due diligence team. While leading Credit Suisse's secondary advisory business, Mike and his team advised on over $20 billion of transactions across both LP and GP deals. Prior to Credit Suisse, Mike spent 9 years at PwC, including 5 years in the transaction services group, where he worked with private equity general partners in evaluating acquisition targets. He's a former CPA and holds a BS in accounting from the University of Illinois. Jake Seyfarth is a principal at M2O and leads its LP secondary advisory business. Prior to joining M2O in February, Jake spent 7 years at Evercore's Private Capital Advisory Group, where he focused on originating and executing LP-led secondary transactions across a wide range of clients, geographies, and portfolio sizes and compositions. Before joining Evercore, he founded and led River Street Capital, a boutique secondary market advisor, for 3 years. He's been involved with the secondary market for over 20 years and has advised on over $6 billion worth of deal volume. Jake has an MBA from NYU Stern School of Business and a BA in English from Penn State. And as we get ready to go deeper into what's happening in the secondary markets, I wanted to just take a second to make sure we're all on the same page with exactly what is a secondary transaction. The term gets thrown around a lot and has lots of different meanings. And so to set the stage for today's discussion, just want to make sure we all understand that secondary transactions are all about liquidity. From an LP-led side, a secondary transaction is when a limited partner is selling an interest in a private equity fund to a buyer. So we view the primary investment as the subscription for an interest, and a secondary sale as selling that interest on a secondary market. Oftentimes, these private equity interests are long-term holds without much in the way of cash flow until the end of term. So LPs who find themselves in a liquidity crunch will sell the asset just as they would a piece of real estate, for instance. On the GP-led side, a secondary transaction is the sale or transfer of an asset to an affiliate managed entity, which can also create liquidity for the LPs. If a general partner has an asset that they're looking to recapitalize or perhaps extend a hold period on, they will sell it to an affiliate fund, and by bringing in new capital, perhaps offer liquidity to their existing LPs who are perhaps seeking to exit that investment opportunity. And so with that foundation, I'll go ahead and turn it over to Mike, who can start talking a little bit about where the secondary market stands here as we're emerging from a COVID environment.
Thanks, Stephen. Thank you for everyone who's taken the time out of their day to join, and happy to be here. Last year was a pretty historic year for a lot of markets, and private equity certainly wasn't the exception. I think what we saw immediately upon the pandemic impact was a complete shutdown of markets for a number of months as both LPs and GPs took stock of what they owned and what their options were going forward. I specialize more on the GP-led side of the market. Jake specializes more on the LP-led side of the market, so I'll let him comment on the LP side. But We certainly saw, as you can see in this chart, a fairly significant ramp up in GP-led secondary volume, and that was primarily driven by large single asset transactions as buyers were looking for places to put money to work in alongside high quality GPs and high quality assets that they can underwrite. And I think some of the challenges with more diversified portfolios really revolved around COVID-related adjustments, and were NAVs a real mark when you looked at what Q1 marks look like and Q2 marks. And so I think it took a while for that those adjustments, and they're still frankly flushing through the system. But in the meantime, the buyers certainly took advantage of the GP-led market, which was ramping, and it had really historic growth over the last 3 or 4 years. Today, as we're entering 2021 and getting on the other side of the COVID pandemic, and things are opening up, I think many buyers are looking at their books and seeing that they'd prefer to have some diversity of exposure, and I think they're looking for, even with the GP-led transaction, I think single asset transactions may be taking a backseat to some more diversified portfolios as long as you don't have to sacrifice quality. In addition, we're hearing from the buy side that they're looking for opportunities where that they can create near-term liquidity in their portfolios. So that's going to drive some changes in terms of the types of GP-led transactions that are getting done, but notwithstanding that, the market remains fairly healthy. And with that, maybe I'll turn it to Jake, who can comment on how that dovetails into what the impacts were on the LP market and how that LP market has developed today post-COVID.
Sounds good. Thanks, Mike. And thank you, Stephen, for having us today. It's great to be here. And yeah, like Mike said, the market last year, starting in March when the pandemic hit, really came to pretty much a standstill. There was very, very little activity initially, other than, there were some anecdotes of family offices who may have been a little bit concerned about, a slowdown in cash flows and impending capital calls that weren't going to be supported by distributions coming at the same pace that they'd been expecting. So there were a few sort of undrawn, unfunded driven decisions to sell by family offices at the beginning, but for the most part, there was very little activity, and buyers were uncomfortable with where pricing should be. Sellers felt that there was really no need to do anything for the near term. They were going to kind of wait and see. And in the end, it turned out to be there was really no denominator effect to speak of. The public markets recovered fairly quickly, and a lot of would-be sellers, a lot of LPs that had maybe planned to do something last year, put their plans on the back burner. Some of them, I think many of them, were haunted by memories of 2008, 2009, when there were some, rash decisions made when people really didn't know how bad things were going to get, and sold a lot at pretty fire sale prices. And then, the lesson I think from that was the world did recover a lot more quickly than people expected, and so people rather appropriately and shrewdly understood that this wasn't going to last forever either. That there was going to be a recovery sooner, probably rather than later. And decided not to make any hasty decisions and rather take a wait and see approach. What was interesting was even when a lot of GPs marked down their books appropriately off the Q1, the Q1 numbers, and pricing was pretty attractive off that mark, you still couldn't find many sellers. Buyers were really paying up for anything they could find off Q1 marks. A lot had been written down, and sellers just again rather appropriately and to their credit, took a very, very patient view that, even if they could get a good price for something, even if they had some desire to get some liquidity, it just was considered kind of a bad look to be selling into a crisis environment. And they had the ability to wait and, wait it out. And there was some, I think, wishful thinking on the part of buyers that there would be, endowments that were going to be underwater because students weren't going to be paying fall tuition, and hospital systems that were going to be, needing to sell because they couldn't perform elective surgery, and then those revenues are going to be down. Very, very little of that happened. There was a little bit of tire kicking, but just no real massive, liquidity-driven decisions to sell. And as a result, coming into this year with the vaccine in view and starting to make the rounds pretty nicely, and now, obviously very nicely, buyers became a lot more comfortable stretching on pricing again. As Mike said, for a while last year, they were more comfortable with single asset deals where, they weren't underwriting a diversified portfolio where half the assets could be consumer retail and half of them could be, healthcare and technology. And they really couldn't get their arms around what the appropriate price should be. Going into this year, buyers were pretty comfortable again with underwriting diversified LP portfolios. And what people are kind of waiting for is a real a major uptick in sellers coming back to the market. There has been an uptick. There's been a pretty significant uptick over the past month or two, but I don't think it's quite a level of opening the floodgates as some people might have expected. And so it's very much a seller's market right now. Demand is really, really pent up. There's some big deals coming out right now. We've got some big ones coming out. There are some big ones that we're hearing about from other advisors, but it's just relative to the number of large buyers that are undersupplied right now. It's still not at a point where they're back at an equilibrium. And as a result, what we've been hearing about and seeing has been really outsized prices, even above forecast expectations on portfolios that come out.
If we can move to the next slide, please. So when we think about the secondary market dynamics in sort of this rapid increase in velocity over the past few years, can you guys maybe talk to what trends have led secondary transactions or secondary opportunities from an LP perspective and a GP perspective to transition from more of a safety item, right, sort of an option of last resort, to, in some cases, an option of first resort, and to really become a tool in both an LP's tool belt and a GP's tool belt?
Yeah, sure. I'm happy to start with the GP side of the market. Frankly, to me, the growth in the GP market has been remarkable. Just the types of transactions that have taken place and the motivations that are driving the various transactions. And I think we have a few slides in here on some examples, which we can get to a little bit later. But to me, I think there's with the buyers being more open to underwriting more concentrated risk and raising bigger and bigger funds and managing individual asset concentration within their portfolio by still participating in the LP market, by still participating in diversified GP-led deals, but also backing and financing really interesting businesses with really high-quality GPs. That's really created the growth in the GP market. I think if you think about motivations for getting deals done in the GP market, liquidity is certainly one thing, but it also could be a GP seeking growth equity capital. Maybe the fund is past its life or doesn't have dry powder to draw upon. Certainly seeking to extend the runway in a business now. They've built a business, put a team in place, professionalized it, done a couple of high quality acquisitions, and teed up a pipeline of M&A activity and organic growth opportunities that historically GPs have lamented needing to sell this to a competitor firm or sell it up market, and providing that liquidity option for investors who want it, but also trying to extend the runway and allowing themselves to have a bigger opportunity from an economic perspective, and their LPs to benefit from that potential growth as well. So I think just the various motivations in the market, I think, have driven the growth in the GP market and the openness of the buyer community to underwrite concentrated transactions as well. And by the way, we've come a long way from where GP transactions started, and that was coming out of the last crisis, where you were funding what were termed zombie funds and GPs who couldn't raise capital and had a portfolio of assets that needed liquidity. The GP may have been underwater from an economic perspective, and this was a lease on life or an opportunity to generate fees. We're well past those days, and I think that quality is what clears the market today from the GP-led side.
And Jake, perhaps as you get into your view, we can go to the next slide.
Sure. Yeah. I mean, a lot of what Mike said applies on the LP side as well. I mean, there's definitely a flight to quality. A lot of buyers are focused on large cap buyout, mid market buyout. One of the interesting outcomes of the pandemic has been that venture has come into more favorable territory than it had been previously. A lot of healthcare and tech focused growth funds are pricing at extremely full prices right now. So energy is starting to come back into vogue a little bit. Infrastructure is very attractive. There aren't too many sectors within the LP space or too many types of funds that are not pricing quite well right now. So one thing that's really made the market robust is that the barriers to entry have gone down for new entrants. And so in addition to all of the multi-billion-dollar kind of larger cap secondary funds focused on LP deals, there are a lot of strategy specific groups that are coming out now. There are groups like Banner Ridge, There are a lot more groups like them that are focused on credit. Klein Hill, which aren't that new anymore, but they've certainly come a long way in a relatively short time and really added a lot of service to kind of the smaller end of the market and also the venture end of the market. So just the number of new entrants that have really succeeded over the past few years, or groups that are maybe about 10 years old, like Hollywood, but they've really moved up market and grown into much larger funds, is really a sign of just how healthy the market is and how much room there is for different buyers with different strategy-specific focus areas and different vintage focus areas. And there's really no segment of the LP market that isn't well served right now.
And so just probing on that a little deeper, it sounds like you're talking about really a distinction of the institutional LPs really as sellers and perhaps financial sponsored buyers, whether it's a Banner Ridge or strategic or one of those. What considerations do you see going into LPs as they start to think about pursuing a secondary or even decide to bring it up to their investment committee for exploratory purposes? And do you see the institutional investors really also show up on the buy side if someone's looking to perhaps get into an asset class that they maybe don't have as much exposure to, and they can buy into a portfolio that's already on the J curve? Or is it really that distinction with institutional sellers and then financial sponsored buyers?
I think it's more the latter. I mean, there was a point where there were some more kind of non-traditional buyers that were coming into the market, and the value they offered was they had a lower cost of capital and they might be able to stretch a little bit more on pricing. But the reality is there are so many buyers now with dedicated secondary teams that really have the capability to underwrite quickly, to move fast, and to stretch on price. They have a lot of pressure to get some of their dry powder out the door, and it's a little bit it's quite a bit tougher these days, I think, for groups that are not motivated to execute on a really fully mapped out secondary strategy to be competitive.
Okay. Well, that then may lead us into the next slide. and Jake, maybe you could talk a little bit about, I guess historically when I've thought about secondary transactions, I've thought of them to be tangential to private equity as an asset class. But it seems the growth is really astronomical, and there's just as much money out there for secondary acquisitions as there is for buyout. It's almost its own asset class now, rather than just being an amalgamation of other asset classes. What are you seeing in terms of the capital raise? What type of clients do you see, or if you have any insight into the institutions that are capitalizing these financial sponsors that are out there looking for secondaries? Where do you see this going from an available capital perspective?
Well, if some of the sentiments in the market, I believe some groups are on record saying this is going to be a $250 billion market by 2025, which could well be. I mean, it's certainly the growth is going to continue. The returns are there. It's funny you should mention kind of historically that it was a little bit more of a niche, because in my previous career as a journalist covering the market, there was a point, and I'm talking back in like 2004, where the head of the publishing company I worked for felt very strongly that I was over covering the market because it was just a really niche area that wasn't really of interest to a very large number of investors. And I continued to cover it very actively at the time, despite that, partly because I saw the potential for growth, and also because I saw the growth in the secondary market is of interest not only to secondary buyers, but to LPs and all the funds that are being bought and sold. That it is truly the liquidity mechanism of alternative investments. And so, I mean, I think the growth will continue to be pretty dramatic. I mean, the word on the street now is that a couple of the big players are about to come out and launch fundraisers this year, heading in the direction of 20 billion for the next fund. So I think that's only going to continue. And you've got groups like BlackRock that sort of got back into the secondary game in a more robust way over the past few years, that are going to be raising larger and larger funds, and some of the smaller groups that are rounding out kind of the more niche strategies. So yeah, I mean, I think the growth is going to continue to be pretty dramatic.
And I think it has to be, quite frankly. I think there's still, notwithstanding the fact that it is a seller's market from an LP perspective, on the buy side, there's just a shortage of capital. When you talk to the buyers today in terms of how they're prioritizing their pipelines, there's a lot of deals that 4 or 5 years ago they would have jumped at the chance to look at, and they're passing on certain of those deals, especially in the GP-led space, because they're focusing on the other opportunities that they have, either an angle on or a relationship with the GP. This market will continue to grow as awareness among the GP investors grows. Opportunities for them to create a longer duration on an asset, to raise support capital, to manage exposure for themselves and their LPs by selling a strip or a portion of assets. And as that, and I've always said it since I was running the business at CS, we just need to educate the market more. And I think once we do that, I think there's going to be more and more deals that come to market within the GP-led space and the LP space as well. I think when you just think about illiquid markets, the natural progression is for them to become more liquid, and the secondary market offers that opportunity. And the more players we have on the buy side, the more robust that liquidity is going to be. So I'm certainly all for it. I think the growth has been fantastic. I think we've tried to structure transactions that are transparent and provide options, especially on the GP-led side of things. So I'm hopeful that we'll continue to scale this side of the market and provide that liquidity option for LPs that may not realize they have it today.
Yeah, and Stephen, one thing I would add actually is that one of the interesting dynamics in the secondary market is that, you know, for all the capital that's available and is going to continue to be available, there's actually a bit of a scarcity of human capital to deploy it. And sometimes, you know, one example I would give is late 2019, there was a little bit of a glut of supply because it wasn't that buyers didn't have money to invest; it was that they didn't have people to, you know, the human capital to look at every deal that came their way. And when there is a big uptick like that, that's kind of one of the issues right now. And one thing that's interesting, I think, is that, you know, as some of the larger secondary firms and even some smaller secondary firms look to continue to staff up and to find, you know, quality talent, it's becoming an area where at one point I think, you know, analysts who went into a secondaries group at an investment bank might have been, you know, sort of looking to put in their 2 years as a means to an end and then get into something more on the M&A side. Now it's actually becoming a destination career choice for people. And that's something that's really needed because there's a lot more, like I said, there's a lot more capital than there is human capital right now. And with the proliferation of new buyers, with the proliferation of new intermediaries, you know, everybody's really, you know, it's kind of a seller's market for talent.
Great, thank you. Next slide. And I think this slide, I don't think we'll spend much time on it now. This just further emphasizes the point that Jake was making, that these are very significant funds. There's a lot of money coming to market looking for these secondary opportunities. And it's going to be interesting to watch this particular chart continue to progress over the next few years. Next slide.
Yeah. The only thing I would say about this chart is if you look at 2020 and that LTM volume, if you would have applied a 20% growth rate to 2019 and effectively ignored the pandemic, which I know we can't, but you know, that capital overhang rate would have dropped from 2.9 to something like 1.7. So an all-time low over the past 8 years or so. Meaning that the market continues to scale and continues to create opportunity. And I think it would have had we not had the pandemic disruption. I think we're going to see that $60 billion number snap back in 2021, and we're going to see real growth rates again, and that capital overhang number is going to shrink. So that's the point of, these are big funds. I agree with you, and they've only gotten bigger over the years, but the diversity of where they're investing their capital has grown, and I think we're going to need more of it.
Great, thank you. So Jake, on this slide, I think this is a really interesting one, talking about the perspective of a secondary buyer. Most of our clients that we work with at Seyfarth are on the institutional investor side. And as we touched on earlier, pro forma, they're going to be coming to the secondary market as a seller, not a buyer. But one of the questions that we're often dealing with in trying to address is, what is the buyer thinking? How is the buyer approaching this transaction? And we ask the question really to help us understand how best we can position a client's portfolio for a max bid, a most efficient sale, and really an accretive outcome for all three relevant parties, right? Buyer, seller, and fund.
Right.
So maybe you can take us through this slide a little bit and help give us some tips and tricks that we can put in our portfolio as we progress and think about these transactions.
Sure. I mean, look, the reality is that for most buyers are looking for some degree of maturity. There are certain buyers that are focused on more unfunded, like AlpInvest is one that I would use as an example, where they're focused on more kind of high quality unfunded and not as much of maturity of vintage. But a lot of the groups, especially the groups focusing on more tail end transactions, they're really some of them really have large armies of people. I know kind of my point about human capital scarcity notwithstanding, but some of the bigger groups out there do have large numbers of people monitoring all the funds in their portfolio and keeping very close tabs on which among some of the more tail end funds have impending upside. And so when a seller wants to sees the need for liquidity and sees an opportunity to divest at a good price, what the buyer is really underwriting to in those situations is looking for which underlying portfolio companies. They do a bottom up analysis and which portfolio companies are really likely to have some sort of a near term liquidity event that's going to get them their money back and then some. And that's really the analysis. And from that standpoint, the real point of this slide is that there's an opportunity cost for sellers if they really do feel the need for liquidity. There's an opportunity cost to holding relative to what they could get out of selling now and then redeploying into higher yielding opportunities.
Got it. Okay. So moving on to the next slide here. And so now we're going to get into some secondary market solutions and maybe take some time to go a bit deeper into how the GP-led deals work. Let Mike give us a bit more context. And perhaps, Mike, as you're going through, you can do it and give us the information with an eye towards not only what is the GP thinking, but what should the LP be thinking when the LP gets a notification? Whereas we use the general term GP-led secondaries, what are the different types of GP-led secondaries, and should the LP think of them differently, whether it's additional growth capital needed or just a long-dated asset or perhaps a zombie asset, et cetera? So with that, I'll turn this back over to you.
Yeah, listen, I think your second question first, in terms of what LPs should be thinking about when they receive a notice. Hopefully, GPs and their advisors are getting in touch, and it's difficult to get in touch with every LP, but there's certainly a starting point with the advisory board or the largest investors, and that's where I would encourage LPs to have an interactive dialogue. Understand when a GP is talking about doing a deal, whether it's a conversation with the GP or with the advisor, what's the GP's motivation? What are the alternatives? What's the process? What's the timeline? What information is going to be available that maybe isn't available today? But that's the way we run our businesses. We try to be as transparent as we can throughout the process from the beginning to end. And as I said, there's it's often difficult in larger funds to get to every single LP, but maintain a communication with your GPs about the process, just so you understand and appreciate the motivations and the alternatives and that sort of thing. As it relates to what some of those motivations are, we highlight in a couple of slides some transactions that we've been working on since we were or at least I've been working on since I was at CS, and we split this up. And this was a COVID-related slide, really focused on this page at the early side of the pandemic, and that is what are GPs doing in times of distress? And you start with asset level financing, and there are a lot of groups that have emerged this year that are providing NAV-based loans to GPs. It's not an inexpensive form of capital, but in a lot of cases, GPs had fully drawn credit facilities, and this was the only capital that they could access to support their portfolio companies that were being severely impacted by COVID. Now, this doesn't just happen in a period of distress. It may happen where there's limited access to capital, or the asset base does not, wouldn't allow for a traditional loan from a traditional bank. So these happen all the time. It became really popular at the beginning of COVID. Annex funds, I would say this is probably less obvious of an opportunity. This is where you're trying to raise capital in a new fund structure that has some type of a preferred return against a portfolio. Some think of this as just having a preferred, either sitting inside the fund and having a liquidation preference for the buyers. But this, again, is where you're trying to raise capital. There may be a difference in viewpoint in terms of valuation, and you're not trying to sell. You want to retain your equity upside and have somebody come in and provide a preferred security to allow the GP to use that capital and then hopefully get that investor out at a capped return and keep the upside for their existing investor base. As we start moving into, start periods of recovery and periods of distress, this is kind of an all-weather solution, and it's been one of the most tried and true, and that's a fund restructuring. Now, people are calling these, multi-asset continuation funds at this point, but think of this as a very old fund that might be 10 to 15 years old that has a handful of assets left that have some upside, need capital for growth, maybe need defensive capital, and a GP is providing a liquidity event by moving all of those assets into a new vehicle and allowing investors to either sell or stay. So it's a way to create liquidity in a really old fund. We find that the uptake on these transactions is generally pretty high. To Jake's point on the previous page, there's an opportunity cost for continuing to own an older asset that's past its cutoff point, particularly when you're holding it at a potentially different basis than a buyer is going to be buying it at. And a buyer can price in a return through some type of a discount mechanism. But this is cleaning up an old fund, moving it into a new vehicle and shutting the legacy fund down. If we flip to the next page, now we're talking about transactions that are really happening today. We're seeing this quite a bit. Continuation funds, these can be single asset, multi-asset. These can be transactions where a GP has had a great run. We have a transaction right now where there's an asset that's a few years old. The GP has done a great job. The investors have actually approached the GP about creating liquidity in the asset, but they also want to retain a position and role to participate in the upside, and some are actually considering doubling down from another vehicle. But this is where you've got a single asset or multiple assets that have done well. It's time to create liquidity within the fund structure, or it's a prudent thing to do, or the LPs are pushing for it. And there's an opportunity to raise growth capital on top of that to continue to support strong assets where you may not have access to that capital. LP replacement with a tender offer, this is simply, we talk to most of our fundraising GPs at M2O. We have a fundraising business. Anytime there's an investor who is exiting or is looking for liquidity through maybe a process that they run on their own, we'll talk to them about allowing us to run a process on their behalf and other investors' behalf with buyers coming in and stapling capital into a new fund. So this is just a tender with a staple that I'm sure many of you have heard or either participated in or gotten notices on. And then the last bucket is really an asset sale. And this is more of, where a GP is typically not involved on the other side. They can be. It can be an asset sale where they're spinning out a team. It can be a strip sale where they're selling a portion of the portfolio into an affiliate vehicle and they continue to manage it. It could be a situation where they've got 7 assets left in the fund, 2 are nearing liquidity, and they're just going to sell the other 5 to an independent sponsor type or a firm that one of the secondary fund of funds will back to manage those assets going forward. But thinking about just selling an asset out of a portfolio, that's really where that captures, the structure captures those types of deals. So again, it varies. In the earlier slides where it was about raising liquidity to support a portfolio either defensively or offensively, it was taking care of an old fund and creating liquidity, or it's capitalizing on high quality assets and moving them into new vehicles, providing a liquidity option as well as an option to take cash. It's LP replacement, where you're just trying to find new LPs as a GP to support your fund. And then an asset sale is more of a rebalancing effort. So you can see with the secondary market, when I started in it years ago, it was really about GPs that were spinning out of captive organizations or LPs selling portfolios. And that GP-led market has expanded so much beyond that, just that spin out into these different options.
Great. And so, Mike, I think that's helpful, and not the least of which, because it really helps bring color to, as I'd mentioned, the umbrella term GP-led secondary. which a lot of our clients we hear, but we don't necessarily get sort of this more granular explanation. So I was wondering if you could take a little bit more time, and I know you tend to work on the GP side, but perhaps put on your LP hat with the knowledge you have about GP-led secondaries. And a lot of our clients, the biggest complaint we hear about a GP-led secondary is we get notice, sometimes, not always, the LPAC has been apprised of what's going on, but ultimately we have 14 days to make a decision. And in our view, the general partner has probably been working on this transaction for weeks, if not months. They have much more complete information than we do, which is not unsurprising, but now we're dealing with a situation where the apple cart is being rocked. We feel like we've gone through a process of underwriting a manager or an investment, and now our feet are being held to the fire. What types of questions, if any, should LPs be asking a general partner right when they get the notification? What information do you think would be helpful to an LP to evaluate whether or not they should pick a liquidity option or a roll option or some combination thereof? Anything in particular?
Yeah, I don't know if there's a one-size-fits-all answer. I think it starts with what I was saying earlier about understanding the GP's motivation, because that'll tell you a lot about the transaction structure, why they're doing it, and that will inform investors what's right for them. It's one of these things that there are many investors. What we try to do, and this really is incumbent on the GPs and the advisor, we try to be as transparent as we can with information. We try to vet enough of the LP base to know that there's going to be support for a transaction. As I said, sometimes it's difficult to get to everyone. In other cases, we've had our GPs send a notice before we launch a process to say, hey, we're about to embark upon this. If you have questions, feel free to let us know. And sometimes those go ignored, and sometimes you get a few questions. But I think it's encouraging GPs to be as transparent as they can and communicate as much as they can about the process. I think it's incumbent upon the LPs to talk at annual meetings and among their within the LPAC and for even the LPAC members to potentially recommend that the GPs have conversations with more of the LPs. But if LPs understand what the motivations for the transaction are, and if there's a structure that provides as much of a status quo option as you can provide in these transactions, and I think we try to do our best to do that, and we may not always be successful in every single LP's mind, but we certainly try to. I think if they understand the motivations and then can internalize that with what's right for their own program, because some investors are looking for that incremental pop. Some investors want to support a GP with high quality assets. Other investors are re-rated in relationships, and this is a great option for them to exit a GP, or this is a great option for them to take liquidity and recycle capital into their program if their distributions, their DPI across their portfolio hasn't been up to their own expectations. So it's really an individual decision, but maintaining that dialogue and understanding and being an active participant in as much as they can in terms of how these things run it would be my only advice.
Yeah, and I think that last point is one that's really important, and we try to emphasize to our clients is the days of writing your subscription document and then being passive until the fund liquidates may be done and gone with. GP-led secondaries are becoming quite prevalent, especially among the more sophisticated general partners, and it behooves a limited partner to be ready and to be prepared. And while the general partner will be hopefully transparent if they've got good advisors working with them, the unavoidable fact is that a GP-led transaction is going to be on a short timetable for the LPs. There just isn't a long time to evaluate. So when we're advising clients as they curate their portfolio, one new tool we're having them put in their toolkit is a formally built out process on what to do if they receive a notification of a GP-led secondary, how they go and get approval for additional capital, if additional capital is going to be required, what are the metrics they're looking at to see if they're going to pursue a roll or a liquidity option. But sort of taking the old saying that fortune favors those who are prepared, and really not waiting to react, but proactively getting ready for that notification to come in from the GP. And I think, Mike, you'd probably agree that those LPs who know what to do and know how to react are probably most successful in dealing with a GP-led secondary, and probably more favorable to the GP for not overloading them with questions when they're trying to close a big deal.
Yeah, and listen, I leverage your advisor too. Like, they're there working for you. We sign a contract with the fund to work on the LP's behalf. So we're there working for the LP, and that's where I think you can get quite a bit of information about the motivations and options and next steps and that sort of thing.
Yeah, that's a good point. And also actually something I think not many people understand is that if an advisor's been hired, they've been hired by the fund, and they represent the fund, not just a general partner. And so LPs should take that into consideration and take advantage of that resource. If we could roll into the next slide, please. And Jake, this is the other side of the coin that Mike just went through. For LPs who are considering an LP-led secondary, again, we understand there's a general umbrella term, but going a layer deeper, what are the different options available to LPs? Do certain options generally apply to certain circumstances? What do you see, and how do you counsel clients in this respect?
Sure, absolutely. Look, I mean, every situation is different. The key part of how to customize an LP process, and that's what we do. We customize every process to meet the LP's objectives. But it really involves a lot of conversations right up front to understand exactly what their objectives are and what they're looking to achieve in a sale. And so if their objectives, as is often the case, are liquidity driven, they look for the cash as quickly as possible, then more often than not, the majority of sales are going to be kind of a straight cash sale with proceeds paid at closing, and pretty simple and straightforward. If their objectives are some liquidity, but they also want to maximize price optic, which is often the case, particularly in a larger organization where there are a number of different board members that have to sign off on a transaction, and some of them are just going to be more concerned about optics than anything else. Then creating a structured solution, deferral solution, where maybe 25% of the purchase price is paid up front, and then 75% paid a year after closing, or some variation thereof. It's going to give them a little bit of a boost. It's going to give them anywhere from kind of a 4 to 7% optical boost in what the purchase price looks like, and then they'll get some cash out up front, and they'll get a deferral on the rest. In other, there's a lot of other structures that are coming more and more into vogue these days. The preferred equity structure is something that there's a couple of groups that are particularly focused on, and that's kind of largely what their business is built around. And I'm thinking of Whitehorse and 17 Capital in particular, but they're certainly not the only frequent providers of those solutions currently. We're hearing about similar situations with ICG. I know AlpInvest has been active on it as well. And that's something that's just a lot more customizable, where if the seller wants liquidity, but they also want to share in the upside, then that might be a structure worth considering. It does not tend to work. It's not out of the question, but it does not tend to work as well when the seller is themselves a vehicle winding up. And I'm thinking about a fund of funds or a secondary fund that is selling underlying holdings to close out an older fund. That tends to create a little bit of a challenge because they have to remain open to manage out the liability on their books of having the pref in place or the SPV. So it's really those alternative solutions are a little bit more applicable to a program that's more of a pension fund and endowment family office where they're more concerned about the liquidity than the timing of being completely divested from the partnerships.
Got it. Thank you. And so, Jake, then with these different options available to LPs, and certainly they all perhaps broadly address the same issue, but all in different ways. From your perspective, when is the right time to get an advisor involved? I know we speak with clients all the time who are considering a secondary transaction, and one thing we hear is, I'm not sure if now is the right time to call up that potential advisor. I know they work on a success basis, and I don't want them to think we're taking advantage of their time. I'm not necessarily interested in a hard sell. I'm really just looking to evaluate options. What's your perspective on that?
Yeah, that's a fantastic question. And look, I mean, in our point of view, the answer is as early as possible. As soon as you think that you're seriously interested in going through a secondary sale process, it's really worth your while to get in touch with an advisor as early as possible and start having those conversations. Because what the advisor, I mean, what the right advisor is going to do, this is a little bit self-serving, but it happens to be the truth. We're very customized in our approach, and we're also very interested in building a partnership and a relationship with the seller, and not trying to give them the hard sell on what they should do that gets us the best fee, but rather what they should do that gets them the best result and the best engagement with the market. We don't want people to feel badly about the secondary market, that the result that they got isn't something that they signed up for, that they left too much on the table, or whatever the case may be. I've had just by way of example, it's a little bit tangential, but I mean, I had a client once who, midway through the sale process, the jewel of the portfolio they were selling, the key asset, turned out to be, they just put out a bunch of announcements about some realizations they had coming up that it turned out that their performance was going to be 5 times what the seller was assuming when they made the decision to sell the asset. And they were starting to get cold feet about it. And I told them, don't sell. It was, it's obviously not the right outcome for us, but our job is to advise the client what's in their best interest. And in that particular instance, I would never want a client feeling like they sold something at a certain price when it turned out that the performance was far superior than what they expected and not reflected in the purchase price they got. And then for the rest of, for the next, 10 years, they don't want to engage with the secondary market again because they feel like, they got a bad outcome. So I think, with the right advisor, you spend some time early on having conversations that are designed, in my point of view, to help you understand your own objectives and help us understand your objectives, so that we can help you through the process of portfolio selection. We can help you through the process of figuring out timing and exactly what you want to do and when and how to customize the approach. If you've got different strategies that you want to sell, and whether to try to sell to a single buyer or in a mosaic solution or run a dual track process, all of those conversations you want to have up front. I mean, we have some ongoing conversations with groups that are still trying to get up to speed on what the transaction related costs are going to be, and you can't get a straight answer to that without having a conversation with somebody who's kind of in the flow of these things. We also have dialogues going on with groups that are concerned they don't have the internal bandwidth to navigate a sale process, even if they do want to go through one and they want the liquidity and they want to get out of some of their non-core relationships, but they just don't feel like they've got the internal bandwidth to allocate to it. And again, that's a conversation that, if you understand what an advisor can offer in terms of scope of services and what can be outsourced and what can't, it can give you a much clearer point of decision making on whether or not you really do have the bandwidth, depending on what kind of service you're
getting. And Jake, one more question for you on the LP side, and this is, I think, mitigates towards getting an advisor involved as early as possible. We haven't necessarily gone into the process of an LP-led secondary, but of course, it's not only a negotiation with the buyer, but once you have a transaction lined up with the buyer, the general partner needs to get involved and approve the transaction through the transfer agreement.
Right.
In LPs, I know historically can be a little bit gun shy about approaching a general partner to seek permission to transfer. In your experience, again, to have a successful LP-led secondary, is there a sweet spot in point of time when you get in touch with that general partner, tell them you're thinking about selling? I know on one hand, people may not want to give a vote of no faith, as it may be seen, in the general partner, especially if the transaction doesn't ultimately go through. But on the other hand, you don't want the general partner to be caught off guard or be caught off on vacation or whatever it is when you're trying to close your transaction.
Yeah, that's a great question. I mean, I would say our view is that you should get in touch with the general partner as soon as you've made a decision to sell and you've finalized, what you consider to be the sale portfolio and which funds you definitely want to include in the process. The first step in that process should be contacting the general partner. And we have talking points and sort of recommended email formats that are designed for managing that relationship as delicately as possible. Oftentimes, a lot of sellers aren't necessarily ending the relationship with the GP permanently. They just don't, they're just getting out of stuff that they feel is sort of a little bit long in the tooth and doesn't have as much life left. And they may very well intend to re-up with the GP's next fund. but they're just selling some stuff that's over a certain vintage. And all of those things are things you want to get communicate with the GP about proactively and constructively, very very early on in the process. The last thing you want to do is engender a kind of a take them by surprise, ambush them, make them feel uninclined or disinclined from cooperating with you. And GPs also tend to have sometimes they're increasingly focused on some of their preferred buyers, preferred relationships. Sometimes they want a staple. Sometimes they have one buyer list that they approve when they're in fundraising mode, and another buyer list they approve when they're not in fundraising mode. All these things, you also need to understand whether there's PTP issues in the fund that would cause a delay in the transfer, whether there's any preemptive rights where you have to let them know what the price is before 45 days before closing, so they can float it out to all the other LPs. I mean, these are all things that that you need to understand, whether there's any tax implications as a result of any kind of AIV you may be invested through. I mean, these are all questions that need to be asked up front so that you don't get taken by surprise, or the GP doesn't get taken by surprise, or the buyer doesn't get taken by surprise toward the end. And the earlier the better, as far as we're concerned. My general rule of thumb is if a seller doesn't want to contact the GPs, they're not a seller. That's generally kind of how I approach things. Is that's really a key first step in demonstrating your own seriousness and clearing the key hurdle toward getting something done.
Great, thank you. So we're just about out of time here. I thank Jake and Mike very much for taking some time to go over some of these issues which we discussed, which are sometimes out of the purview of us as the lawyers, but certainly come up and are certainly incredibly relevant. Jake, Mike, any last point, maybe if you can give the LPs on the line for one thing to bear in mind, maybe one, if they can only take away one thing from this webinar from both an LP and a GP-led side, any final points?
Yeah, sure. I mean, I guess one thing, I don't know if this is, I'll throw this out there. I mean, one thing that I've learned, in over 10 years of doing this is that time is always your enemy in these transactions. There's just a lot of frictional issues that tend to work against transactions getting done and not necessarily in favor of them getting done. And so the more time you let go by unnecessarily, the more you increase risks that something will go a little haywire, that another pandemic will flare up, or some other crisis in world events will emerge that'll cause a buyer to pull back, or a GP to not want to transfer, or whatever the case may be. I've seen it over and over and over again, where if something causes delay I mean, I know this because you guys are pretty efficient on the legal end, and sometimes that can be a little bit of a logjam. But anything that creates any delay or any friction in getting something moving along as quickly as possible, particularly once you have an agreement in place and you want to get a PSA signed and lock it down, it's just always good to try to move as quickly as possible. Once you've made a decision, it's really good to kind of move as quickly as possible and lock a buyer down, lock a price down, lock a PSA down. I know you and I have been through an experience together where we had a bit of a buzzer beater getting a few PSAs signed right before COVID flared up, and I had some inquiries shortly thereafter from some buyers wanting to see if there was any wiggle room around the price, and the answer was no, and that's because we moved quickly and efficiently.
Yeah, and from my end, and I've said it a couple of times, just with GP-led transactions, try to be an active participant to as much as you can, and that means understanding the motivations for the transaction and what the options are, and then thinking about your own needs. Engage with the advisors who work for you on these transactions, and ask questions, and ultimately you'll make the decision that's right for you and your portfolio.
Yeah, and I would say my takeaway for the institutional investors out there, most of them have sizable staffs that focus on underwriting funds, underwriting acquisitions. I'm only aware of maybe one or two groups that have a dedicated in-house secondary person. These transactions, because they may be unknown, even though they've been around for a while, can sometimes seem scary. I would say, when you're confronted with the possibility of a secondary, whether LP or GP-led, be proactive with it. Get in touch with an advisor who's there to help you and look out for your objectives. I know I've worked with Jake on a number of LP-led secondaries, all of which have had fantastic outcomes. And to the extent, as Mike said, you can be an active participant, you're likely to maximize outcome for your portfolio. And so with that, want to thank everybody for coming or for attending today's webinar. I don't think we're going to have time to get to questions today, but certainly please feel free to email us offline. We'll get back in touch with you with respect to any questions you may have had that we weren't able to address. Again, copies of the webinar recordings and the materials will be available in the days to come. Again, special thank you to Jake, special thank you to Mike for taking time out of your day to come on and really share a state of the market with us. I know it's really appreciated by all. And with that, have a great rest of the day. Thank you. Bye-bye.
Thank you, Stephen.
Thanks, Stephen.